a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about low volatility ETFs. And we know that markets have been on this roller coaster ride since the start of the year, and that is mainly because of concerns related to higher inflation, rising rates, and Omicron variant, which has been spreading fast. So the Fed could raise rates to tame inflation, and in fact, the Fed funds rate futures currently indicate about 73% probability of a rate hike in March, of a 25 basis points rate hike in March, and about 27% probability of a 50 basis point rate hike in March. But investors should remember that while earnings growth and economic growth both are expected to slow down from the record pace last year, they are still very impressive and in the positive territory. The economy could grow at about 4% rate, and EPS growth rate may be around 10% this year. So the bull market is likely to continue, but we may see that defensive, boring areas of the market may outperform in the current market scenario due to rising uncertainties. And so we'll take a look at two very popular low and minimum volatility ETFs. Now, these ETFs tend to outperform or hold up rather well during market declines, but they will underperform the market, the broader indexes, when markets are very, very bullish. And according to traditional finance theories, obviously investors should demand a high rate of return for taking on greater risks, but some academic studies which studied the low and minimum volatility factors, they showed that lower risk stocks outperform with higher risk adjusted returns over the long term. And one of the reasons why this could be a fact is because investors tend to chase hot, riskier stocks, and they tend to ignore boring, low risk, cheap stocks. Now, investors should also understand the difference between low and minimum volatility. These are the two types of low volatility factor ETFs you will see in the market. So we'll take one of the most popular from minimum volatility and low volatility. So let's go to the quote page on Zacks.com to take a look at these ETFs. So the first one we are highlighting is by iShares. It is the most popular product in this space. The ticker symbol is USMV. So this says minimum volatility. So it focuses not only the volatility of the stocks that are in its portfolio, but also correlations between those stocks so as to construct a portfolio which has lower volatility compared to the broader market. Very popular with 28 billion in assets and pretty reasonably priced at 15 basis points. Now, you can go to the Zacks quote page, read our research report, articles, and then you can use the link to go to the iShares webpage for this ETF and learn more, look at the holdings, etc. So stocks with potentially low risk, but that in the aggregate, the portfolio has lower volatility relative to the broader equity market. Now, if you look at the holdings, you will see Johnson & Johnson, Verizon, PepsiCo, Kroger. These are the top holdings in the ETF. In looking at the sector exposure, IT, healthcare, consumer staples, and communications. These are the top holdings. So some more tilt towards the defensive sectors compared to the broader indexes. The second one that I'm highlighting is by Invesco. This is a low volatility ETF. The ticker symbol is SPLV. So this basically looks only at the volatility of individual stocks, and this holds 100 least volatile stocks in the S&P 500 index, then weights them by their volatility. This is also pretty popular with 9.5 billion in assets, and this has an expense ratio of 25 basis points. Again, you can go to the quote page on Zacks.com. A nice dividend yield too. Then you can use the link to go to Invesco web page for this ETF. So this selects 100 securities from the S&P 500 index, which have the lowest realized volatility over the past 12 months. So these are the main differences between these two ETFs that I talked about. Now, looking at the sector allocation, this is more tilted towards defensive sectors than USMV. So consumer staples, utilities, industrials, and healthcare, these are the top sectors in the ETF. And looking at the top holdings, Hershey, Procter and Gamble, PepsiCo, and McCormick, Verizon Communications, these are the top holdings in the ETF. Now, on the last two slides, I have the comparative performance. So this is comparative performance over the past 1 year. And you will see that the Invesco product and S&P 500 had similar performance. The iShares product was slightly lower in terms of performance. And this is the performance for the current year, for 2022. You will see that both these products have outperformed the S&P 500 index. The Invesco product has outperformed a little bit more, so both are down less compared to the S&P 500 index, but these are not no volatility, so they will be down when markets are down, but they may hold up a little bit better than the broader index. Thanks for watching. Make sure to check out zacks.com/promo for an interesting offer, and I'll see you next week.